Okay, let's unpack this. Today, we're doing a deep dive into, well, a really fascinating and pretty complex business scenario. Sable Offshore Corp. Think of this as your essential guide. We want you to understand a company that's sitting on a massive opportunity, but also facing some equally massive hurdles.
That's right. And the sources we've gathered for this, financial reports, market analyses, all that, they really paint a picture of a classic high-risk, high-reward situation. At its heart, it's all about Sable's big plan, restarting oil production. And not just anywhere, but in federal waters, right off the California coast.
Right. So our mission here is clear. We're going to sift through all this info, pull out the most important bits,
Yeah.
help you quickly get a handle on both the, let's say, the significant upside and the considerable risks. And this isn't just about Sable, is it? It's kind of a perfect case study. You see how all these things, legacy infrastructure, tough regulations, market feelings, even like the energy transition, how they all crash together in one company's story. Let's get into it. So to really get this high-stakes game, we need to know who we're talking about. Sable Offshore Corp.
Yeah, they're an independent oil and gas company.
Okay. And they've got operations offshore.
Uh-huh. 3 platforms, Hondo, Harmony, and Heritage. Plus, they've got an onshore processing facility that's at Las Flores Canyon.
Wow, okay. And it covers a lot of ground.
It does. About 76,000 acres across 16 federal leases.
And how did they come about? What's their origin story?
Well, they picked up the San Ynez unit, people call it the SYU, from ExxonMobil. It was actually a seller finance deal. Then more recently, February 2024, they merged with Flame Acquisition Corp. And bam, became Sable Offshore Corp.
Got it. The SYU. You mentioned it has a history.
Oh, yeah, quite a history. Significant production in the past. We're talking 112 wells already there, 90 producers, 12 injectors, 10 sitting idle.
And potential for more.
Definitely. Surveys show 102 spots they could drill but haven't yet.
So what's fascinating here is...
It's that this historical asset is exactly what Sable's focused on now, restarting production.
Yeah.
Because remember, it's been shut down since that pipeline spill back in 2015?
Right, under previous ownership.
Correct. So it's not about finding new oil. It's about turning the taps back on for a known major asset.
Okay, so that's the setup. But knowing it's been dormant for, what, almost a decade? Why are investors suddenly getting excited? Here's where it gets really interesting, right?
Yeah.
Where's the big upside?
Exactly. This is the core of the bull case. They actually reported, this was May 2025, that production has restarted. Initial flow is about 6,000 barrels a day going to Las Flores Canyon.
Okay, so proof of concept. Sort of.
Sort of, but the real aha moment, the thing that gets investors really buzzing, it's the reserves. Specifically, the contingent reserves in the SYU. Estimated at, get this, $10 billion.
10 billion, wow.
Yeah.
But contingent means not quite locked in.
Precisely. Contingent means we know the oil is there, but it's not proved yet. It needs more work or regulatory green lights to be commercially viable.
Yeah.
So the whole bet on Sable is, can they successfully keep production going and turn that potential into proved reserves?
And if they manage that,
If they do, you could see a major revaluation of the company. Their market cap now is around, what, $2.57 billion? Yeah.
so converting those reserves could mean, maybe a 4x upside. Potentially.
A 4x upside. That definitely grabs your attention. And it's not just the oil itself. They have other advantages. You mentioned infrastructure earlier. They own it all.
Yes, and that's huge. Pipelines, processing facilities, it's all theirs.
Which gives them...
Control. Critical operational control. They're not depending on others for moving or processing the oil. In this sector, that can save a lot of money and headaches. It helps protect their margins, which is key for profit down the road.
Makes sense. And we also see high insider ownership. That usually helps, right? Aligns management with the shareholders.
Generally, yes. It boosts confidence that management is thinking long-term value.
Plus, it looks like some sophisticated investors, the smart money, are interested.
Right. Hedge funds like Greenhaven Road Capital have pointed out the potential. They like the recurring revenue possibilities, the operating leverage, and the potential for high free cash flow yield once things are really humming.
How many funds are in? As of Q3 2024, it was 11 hedge funds. That's down a bit from 16 earlier, but still significant interest from players who do their homework. And if we connect this to the bigger picture, the whole energy transition thing, Sable's position is pretty interesting.
How so? They're an oil company.
True, but their existing infrastructure, it's actually quite well suited for carbon capture and storage, CCS projects.
Ah, okay. So turning a liability into an asset, potentially.
Could be. It aligns with where the world is trying to go, decarbonization, and it could open up completely new revenue streams later on.
And they're natural gas.
That could be important too. Natural gas is often seen as a bridge fuel, lower emissions than coal, so it could be valuable for power generation, maybe even for data centers, which need huge amounts of power. It gives them another angle beyond just oil.
Okay, let's talk valuation and money. You mentioned the market cap. How does it look compared to assets or peers?
Right now, Sable trades at a discount to its NAV net asset value and also compared to similar companies. Some analysts think if they can get those reserve upgrades confirmed, it could unlock a lot of value.
And it's maybe under the radar because not many analysts cover it.
That seems to be part of it, yeah. Limited coverage can sometimes mean a stock is overlooked.
And the stock has performed well recently.
Very well. Up over 160% in the 52 weeks leading up to June 2025.
Wow. And they've raised money to fund all this.
They have significant amounts. $502.4 million came in Q1 2024. That was through a PIPE deal, private investment in public equity and trust funds. Then, in Q3 2024, another $150 million from a private placement, plus $72.5 million from people exercising warrants.
Warrants being.
Options to buy stock at a set price, so investors converted those into shares.
And all that cash is going towards the restart in operations.
Pretty much. It's crucial fuel for getting this engine running again.
Okay, that's a compelling bullish case. Strong potential, strategic assets, smart money interest. But there's always a but, isn't there?
Yeah.
So what does this all mean when we look at the other side? Let's dig into the risks.
Absolutely. And the risks are substantial. Let's start with the financials. They reported a big net loss in Q3 2024, $255.6 million.
Oh, what drove that?
A lot of it was non-cash warrant liability adjustments, accounting stuff related to potential future stock, but also real costs for the production restart and, of course, interest expenses.
Yeah, profitability metrics look bad.
Yeah, really bad right now. Return on equity is deeply negative, minus 200.53%. Return on invested capital also negative, minus 8.54%. These aren't just numbers. They show how much cash they're burning through just to get going and how far they are from actually making money in the short term.
And then there's the debt. That always makes me nervous.
It's definitely something to watch closely here. They're carrying about $814.4 million in debt as of Q3 2024.
And a big chunk is from ExxonMobil.
That's right. $623 million is a seller-financed term loan from Exxon, and it has 10% PIK interest.
PIK, paid in kind, meaning the interest adds to the loan.
Exactly. Instead of paying cash interest, the debt just grows. That can get heavy really fast if things don't go according to plan.
And cash levels versus spending.
That raises an important question. They had about $189 million in cash, but their annual cash burn rate was around $310 million.
Now, they burn through their cash in less than a year at that rate.
Based on those figures, yeah. It strongly suggests they might need more capital soon, which could mean issuing more stock and diluting existing shareholders.
Okay, financial strain. What about the operating environment? California isn't exactly easy for oil companies.
Notoriously difficult. California's environmental regulations are among the strictest anywhere. And remember that 2015 Refugio spill under the previous owner that led to a consent decree? It meant huge pipeline repair requirements.
And Sable's still dealing with that fallout.
They're navigating complex permitting processes constantly. It's a major hurdle.
Plus, I saw something about legal issues. Investigations.
Yeah, recent posts on X, the platform formerly known as Twitter, mentioned 2 law firms looking into Sable. They're investigating if the company might have misled investors about the timing of the restart, especially just before a big $295 million stock sale.
That's not good. Regulatory scrutiny, too.
State regulators and courts are definitely keeping a close eye on them. Adds a layer of legal uncertainty.
And there was mention of a potential lawsuit by Sable against regulators.
Right, a potential constitutional takings lawsuit. They might argue regulations effectively took their property value. The claim could be huge, like $10 billion. But that's considered a real long shot. Very uncertain, could take years if it happens at all.
So, regulatory and legal minefields. What about the actual operations? Getting the oil out?
Big operational risks there, too. Those pipelines, line 324 and 325, used to be 901 and 903. They're old, over 30 years, and they have a known history of corrosion issues.
Even after repairs?
Repairs have been done, yes. But any new failure, that could halt production again, maybe lead to environmental fines, cleanup costs, big problems.
And just restarting something this complex, That's risky in itself.
Absolutely. Execution risk is significant. Restarting dormant offshore platforms and pipelines involves huge technical and logistical challenges. Delays, cost overruns, those are very real possibilities.
And the market, you mentioned volatility.
Extremely volatile. The stock's weekly volatility was around 13% over the last year. That's higher than like 75% of U.S. stocks. It's a wild ride.
Energy prices always swing.
Exactly. The whole sector is sensitive to commodity prices. Sable sells its oil linked to Brent crude, which helps a bit with stability. But natural gas prices, for instance, dropped almost 5% just in May 2025. Those fluctuations directly impact potential revenue.
Okay, so if we look at market signals, technical analysis, short interest, what's the picture?
It's pretty mixed, honestly.
Lots of people betting against it. Short sellers?
There's significant short interest, yeah. About 14.28% of the available shares, the float, were sold short. That's 12.77 million shares. So yes, bearish sentiment is definitely present.
Okay.
But interestingly, that short interest actually decreased by almost 27%.
Meaning some short sellers close their positions, maybe getting less bearish?
Could be. Suggests maybe sentiment is improving for some, or they decided the risk-reward changed.
And technical charts.
Also mixed. TradingView analysis suggests a sell rating short-term, neutral over a week, but a buy over 1 month.
Confusing.
It is. Resistance level seen around $30.10, support near $24.15. There are some other indicators, like the MACD, suggesting sell signals too, and a potential reversal point back in May. So technicals lean a bit negative in the very near term.
So, okay, let's try to pull all this together. Synthesize these opposing views. Sable Offshore, at the end of the day, it really looks like a highly speculative investment. Huge potential upside, yes, but matched with really significant risks.
Right. What's fascinating here, I think, is boiling it down. Long-term success seems to hinge on maybe 3 core things, plus an opportunity. 1, the production restart. Can they actually sustain it, scale it up, and critically convert those contingent reserves into proved ones? That's job 1.
Makes sense.
2, navigating regulation. Can they handle California's tough environment? Avoid more legal trouble?
Crucial.
3, debt management. That high debt, the cash burn, they have to manage their finances carefully. And then the 4th element, the opportunity, energy transition. Can they leverage that infrastructure for CCS? Make the natural gas play work? That could be a real differentiator long term.
Okay, so for you, our listener, what does this actually mean if you're thinking about this company? It sounds like this is really only suitable for investors who can stomach a lot of risk.
Yeah, absolutely. High risk tolerance is a must. And you need a long time horizon. Think 5, maybe 10 years. This isn't a quick flip.
And what should people watch?
Keep a close eye on production updates. Are they hitting targets consistently? And watch those regulatory and legal developments very carefully. The outcome of those investigations could be pivotal.
So you need to balance the good signals, the valuation discount, insiders owning stock.
Against the negatives,
Yeah.
the technical sell signals, the short interest, the debt.
And definitely don't put all your eggs in this basket.
Oh, absolutely not. Diversification is critical. Sable's volatility and all the sector-specific risks mean it shouldn't be a core part of anyone's portfolio.
So maybe wait and see for conservative folks.
That's one approach. Wait for clearer proof of sustained production, maybe some resolution on the legal front. Or if you have that high-risk tolerance, maybe a very small allocation, like 1 or 2% of a portfolio, perhaps, to balance the risk and the potential reward.
So wrapping this up, we've taken a pretty deep dive into Sable Offshore Corp. And it really reveals this fascinating, complex interplay of huge opportunity and equally huge risk. It's quite the story.
It really is. And, this raises an important question, I think, for all of us watching the energy space. Given all of these layers, operational, financial, regulatory challenges, plus this massive potential value unlock, how do companies like Sable actually do it? Not just restart operations, but truly redefine their role as the energy landscape shifts so fast? What does a case like this tell us about balancing these old legacy assets with the very real pressing future energy needs? It's a tension we're going to see play out again and again.